Welcome back to the channel. I'm a 21-year-old investor looking to compound my wealth in the stock market. And for today's video, I'll be covering some of the stocks that have been falling over the past weeks. So this is my portfolio here. I've made some new buys over the past week and I've trimmed my HCC position as well. So the first company that I'll be covering is actually Duolingo. So Duolingo is a company that was once loved by the markets when it was at $500 a share. And currently now the stock is hated by the markets. So a lot of people FOMOed into the stock following Joseph Carlson. If it went well, all would have been good, but when it falls, people are quick to point fingers at him. So the stock is down, but the metrics are good, but do note that your daily active users is actually growing faster than your monthly active users. So what that means is that they're not necessarily growing at 36%. It just means that people on their platforms are using it more frequently. So it's not bad for loyalty, but just know that 36% might be a lot lower than what the actual number is. So there's many people comparing Duolingo to Netflix, but right? The thing about Duolingo is unless the company can turn the company's products into high perceived value informative products, most subscribers will just end up subscribing and leaving almost immediately. So consumers are more willing to pay for convenience and entertainment rather than for education, and especially if the education is of low perceived value. For Duolingo, the app just seems like a fun app for kids, and for Duolingo, the only lever that I can see for the company is them being able to scale their ads division. So those that are saying that Duolingo can turn into a translation app have missed the point. Why would someone download an app like Duolingo to translate? They can just do it on Google anyways. So valuation wise, the company is okay now, I would say. The price to earnings ratio is at a 55 to 56 times, and it is growing revenues at 30 to 40%. So not too bad, but I can understand people adding at this price. It's not my type of investment, so I'll be staying away from this, but hopefully it turns out well for you from here on out. Next company is Constellation Software. This stock is down around 26% year to date. So this stock is down around 20% after Mark Leonard's retirement. So the stock has done very well over the past 10 years, but it is currently in its deepest drawdown in the entire history of this company. So their earnings came out also, and then revenue grew 16%, net income grew 28%, free cash flow grew 46% also. So everything is moving in the right direction. And from a valuation standpoint, the company is currently now trading at a 28 times price to free cash flow available to shareholders. So I know over here it says 19%, but this one is a lot lower than what the company uses. The company's favorite metric is their free cash flow available to shareholders. It's your FCF A2S, which you can find in their earnings letter. So this one here is a lot lower. It's around 28 times today. So the problem with mergers and acquisition companies like this is it's impossible to assess the merger and acquisition activity. So Mark Leonard was an amazing capital allocator, and now with the new management team, the confidence and the clout is gone. It's same for Buffett as well as Berkshire. So after Buffett steps down, maybe the confidence for Greg Abel will be a lot lesser compared to Warren Buffett. So this is a piece by Morgan Stanley here, and as you can see, only 17% of companies surpass their synergies forecast when doing mergers and acquisitions. So it's poor and unpredictable, and what I normally prefer would be companies that give it back through buybacks rather than through acquisitions. So for Constellation Software, I understand people buying at this price, but a lot of the thesis is actually betting on the people in charge rather than the business itself. So it's not extremely predictable, so not for me. So next company is a company that a subscriber left a comment for. It's Axon. So the company sells your taser. That's a very cheap upfront purchase. It doesn't seem extremely expensive. But what they do is they sell you a ton of stuff after that. So it's like an Xbox where you buy the machine, the Xbox thing for $150, and then they sell you the games that cost $80. And then when you buy one game, it's not enough, so you have to buy two, you have to buy three, and then the upfront cost is very little, but the cost after that is extremely high. So this is what Axon does also. They have the cloud platform. So the story for this name is simple. What they are trying to do is they're trying to shift from hardware demand to more of software demand. So software is more scalable, higher margin, and is overall the better business model. So that is what the company is trying to push for right now. I believe they have around 50% of their revenues under this hardware portion, and the other 50% is from this software division that they have. So market share wise, the company has almost a monopoly in this space, around 80%. So the next question would be, can another taser company come up with this? So it's not wrong, but that's where Axon comes in with their bundling mode as well as their high switching costs. So what they've done, as shown in the previous one over here, is they bundle everything together, and because it is crime related, there's high switching costs also. And the longer the police use it, the stickier it gets because all the data is already on their platform, so it's impossible for them to switch. And there's also high regulatory barriers because it is a restricted product. And the company also says here that the total addressable market is huge. So they currently only have a very small chunk of this entire total addressable market. So what the management is saying is that the growth is almost limitless for this company. So the stock is still quite expensive. The profit margin now is around 18% for this name. So even if the company goes up to around 29% profit margin, similar to another company, which is Fortinet has their hardware as well as the software division as well, then the price to sales is still at around 12 times. So it's pretty expensive. So it's a great company, but very expensive. Unless you can model this company to grow for the next 10 years at such strong rate, I would avoid this name. It probably will, but this is an avoid for me. Next company is Celsius. The stock is down around 25% over the past week. So they reported earnings last week and their earnings were okay, I would say. So revenue for the entire portion of the business went up 173%. And in fact, I would say the numbers are quite strong in terms of revenue as well as growth numbers. So they recently bought another company, which is Alani, and the overhang with Pepsi is over already. So what happened last year was Pepsi over-ordered, and currently now the ordering is normalizing, and that is why you're seeing the revenue going up by such a fair amount over here. So overall, I would say the headwinds for the companies are over. The company will continue with its growth here on out. So the net income over here is negative, but if you're to look deeper, there's actually a line item that distorts this. So it's their distribution termination fees that they have to pay. So the company bought over the other company, which is Alani, and they're passing all these distribution rights to Pepsi. That's why they had to pay this fee. So normalized, the company is currently trading at a 36 times of earnings. Considering the high growth for this one, it seems justified. So this is from their 10K as well, and what they have mentioned over here is that Pepsi will reimburse all these fees soon. So potentially in the next quarter, we could see a big earnings beat that will push up the share price. This could be a catalyst if you're looking out for this as a shareholder. So it looks interesting for a catalyst play. The stock falling 20% seems a bit unjustified given the high revenue growth. So this could be a company that looks interesting in the next quarter. Next part, Michael Burry is now bearish on the hyperscalers. So he's now claiming that companies are artificially inflating their earnings, which might be true. He released this graphic over here also, talking about useful life. But bear in mind, he has a short position, not saying whatever he is saying is untrue, but he has vested interest as well, with around 70% of his entire portfolio in puts. So AI could well be a bubble, but it took him 3 years before the collapse in 2008. So in 2005 and 2006, he was already betting on the stock market falling, and it was not only until 2008 before his puts actually came into effect, and his puts made him profitable in 2008. So I'm not saying he's wrong, he probably knows a lot more, but it seems a bit manipulative over here given his short positions just a few days ago. So anyways, I bought more Meta as well, and I released the Substack newsletter here, so feel free to check it out. So for Meta, I would say it is one of the hyperscalers that has limited downside potential in terms of earnings, given its ability to channel all its investments into its existing business to a much greater extent than your other hyperscalers. So other hyperscalers like Amazon, like Google, like Microsoft as well, they're dependent on external demand, whereas Meta is not so much dependent on that. So the thesis here is that the market thinks that Meta is overspending on crap, but I think otherwise. I hope you guys have found this video useful. Thank you so much for watching. I'm a bit sick today, that's why the camera is off, but invest safe.